back and we came to the conclusion this was quite a nice looking business. Trouble is, everybody already knew it was quite a nice looking business and it was trading at a pretty high set of multiples. Well, fast forward to now, and they've released at the start of this week on Monday, who have been paying attention to this stock for longer than we have already seen 3/4 of this happening in real time. So most of this isn't really a surprise. What you're learning is a bit about guidance for the next year and so on, as you always are in these things, but also what happened in Q4. The stock, by the way, is down 12% this year in what's actually been a pretty decent year for the FTSE 100. So we were saying a while back we'd be interested in this if it was a bit lower. I wonder whether it's starting to get into range. See what you think. So organic growth, this is one of these companies that does a combination of organic growth and growth by acquisitions. So they are a contract catering business. They run food outlets in stadiums and universities and hospitals and various other places, offices and whatnot, through a variety of kind of subsidiaries. So they have individual local businesses that all operate under this kind of Compass umbrella, try and combine then the benefits that come with scale, i.e. bulk purchasing, lower costs of spreading bigger margins by spreading your costs over a wider revenue base, but combine that with local expertise. So far, so good. Organic growth, which is the bit that the market always likes because they're always wary about acquisitions, rightly or wrongly, and I think in the case of Compass, it might be wrongly, came in at 8.7% for the year. Okie doke. Looking at that in a historic context, you can see why the stock has been sliding a little bit. So bear in mind, this was a company that suffered quite a lot during the pandemic because a lot of stuff got closed, and when stuff is closed, they don't need people cooking food in them in the same way. So with no live events, or relatively few live events and relatively few offices, quite a bit of Compass's businesses dried up and their revenues went down. So revenue growth came out pretty high from 2022. It came out organically as 37.5% increase, but that's coming off some low comps. Then on to 19% increase in 2023, 10% increase or 10.5% increase in 2024, and for 2025 we come in at 8.7%. How does that fit into the sort of general shape of the quarters? Well, 9.2 in Q1, 8.5 in Q3, 8.6 in 8.5 in Q2, 8.6 in Q3, and about 9 or so in Q4. So a good final quarter, not a kind of light shooting out one. Looking ahead, they are guiding for somewhere around the 7.5 mark organic growth for next year, with a couple more percent to come from M&A, which gets you to 9%. Margin expansion takes you to sort of 10%. There's a kind of aim for the long-term operating margin. So that should, operating margin growth, taking you to 10% in operating income growth here. And that gives you a stock that's trading at a P that's roughly double the FTSE 100 average at the moment. It's twice the size of its competitors, and that gives it a kind of biggish advantage, and they do the thing of letting people, external third parties, not strictly competitors, that they're kind of up against, buy through their buying platform, which gets them lower costs, but they charge them for doing it. So Compass gets quite a nice revenue stream by letting people use its platform and benefit from its scale advantages, or at least the buying part of its scale advantages. It's twice the size of its nearest, the size of its nearest two competitors combined, but still only about 11% of the market. So there's loads of room to keep rolling stuff up here. They're expanding through Europe at the moment. The kind of bulk of their business comes out of the US. They have been talking a little bit about tariff threats, as a lot of companies have. And if you imagine a company that's a food business like this, imports ingredients from quite a few places, tariffs are a potential issue there. I'm starting to wonder about tariffs a little bit in general, in the sense that the legalities of these are under some real question marks, I think. And it struck me that there was never going to be a kind of redress for these sorts of things. But the people I've been hearing from on various podcasts and stuff are not ruling that out, that companies that have been paying tariffs that shouldn't have been in place might well get a check back in the post at some point in the future. So watch that space, but not specifically for Compass. Watch it in general. We're now at a price to earnings of 36, a price to free cash flow of 21. The reason there's such a big difference between those is because they're a big acquirer, so you have things like goodwill rolling off, and that goes through the income statement. Forward PE is about 16.84. I say about 16.84. Apparently, it's exactly 16.84 according to Yahoo Finance. I reckon 10%, and I might be interested in that. Steve, what do you think?
It's going to grow at 10% next year, isn't it? So you probably get that if you're prepared to buy it today and hope it doesn't go up 12%. Where it goes up, that's the risk you're going to take. So yeah, it looks quite attractively pricey, and every time I look at this company, I'm kind of shocked at how big it is. I forget the kind of size of company we're talking about. We don't have many companies in the FTSE 100 that are talking about, $46.1 billion of revenue growing at, nearly 9%. It's pretty impressive growth for a company of that size, especially a FTSE kind of company. So yeah, it's quite impressive. It's been a solid grower, and shareholders have rewarded it for its progress with that healthy PE ratio. So this is probably one of the companies that isn't talking massively about shooting off to the US, because actually over in the UK it gets the sort of attention that it deserves. But yeah, it's a massively impressive business. This acquisition of Vermaat is my attempt at pronunciation. 1.5 billion euros, a premium food services business in Europe, has just been acquired. As you say, Steve, very fragmented. So these guys can just go and roll up companies all over the world and expand however they see fit. I guess eventually they're going to come up against CMA on stuff like this, but we'll have to see. Your point on the tariff, Steve, is also really interesting. I haven't seen anybody without serious bias tell me that these tariffs are particularly legal, and uh, and I agree with you that I think that there's a chance of the cash having to be returned, and part of me thinks that's why Trump has promised that $2,500 out to the American public, so he can say, "Look, I was going to give you this, but then the courts have took it off you," kind of thing, as a sort of destabilization tactic. So yeah, or the greedy corporations have done it, but yeah, I don't think there's much chance of not getting the cash back on that. So I don't worry about the tariffs that much at the moment. But look, we've been shocked before. We'll be shocked again. Steve, you didn't mention that the dividend had gone up 10.2%. That's obviously a very big change for them as well. But yes, outlook looks pretty good as well. I think they're looking at profit growth of about 7% organic revenue growth, roughly 2% profit growth from M&A, continued margin progression, which is something they've been doing over the last couple of years. It looks a really good report again, Steve. The market is sent it down 12%. Do you know why that is, Steve? Is it not operating to its plan quickly enough?
My sense is that it's to do with slowing organic rates. So no one expected realistically this company was going to keep going at 37.5% for any length of time whatsoever. But it's a growth stock. It's priced like a growth stock, or I mean, it still is priced like a growth stock. PE at 36 is growth numbers. And I think there is just a little bit of a thought in the minds of investors of, well, how low does it go? So we went from 37 to 19, okay, and then 19 to 10, and we're still going down from 10, and we've reached 8.7, and we're going to keep going down from 8.7, and we're going to get to 7.5 probably. And then their sort of medium to long term guidance is mid to high single digits. Okay. Mid to high single digits, call that 6 to 8 or something like that for mid to high. If you come in at the bottom end of that, that's not a huge revenue growth thing. You can prop that up with various things like margins, like acquisitions over the top. But if you think organic growth is the number that matters, my sense is that number's slowing and continuing to slow, not just slowing because it was weirdly high in 2022, sure. My instinct is that continuing to slow is a big part of the reason why this thing keeps going lower. if they start coming in ahead of their 7.5, I mean, there's been quarters here where they've been up around the 9 mark, and if they get themselves back up around the 9 mark in terms of organic growth, I think I would expect the stock to go up. If their next organic growth number begins with a 7, I expect it to go probably down a bit. They are guiding for this, so it kind of ought to be priced in, but I wonder whether they think that guide is a little low, and they're on the way to stabilizing around the 7 mark, I think. And that's the way I'm thinking about this, where I think about this as a potential buy. I think, okay, if we're going to get 7 or so going forward, what does that look like? You can add a bit on for acquisitions. You can add a bit on for widening margins. You need a reasonable starting point, I think, if you think that's what growth is going to look like for the foreseeable. And forward P of 16.8, that's probably not terrible. You'd be looking at a peg of something like 1.5 or 1.6 perhaps. I've seen worse, especially if you think they're going to be able to keep going at 10 or so operating income.
Yeah, it's interesting, Steve. It's been on my watch list since we talked about it last time, but I guess now I have to take a bit of a closer look at it, really. For me, I think the platform aspect is one of the most important parts of the business, and I need to really get to grips with. I think I said this last time. It feels like a deja vu kind of thing, but I really need to get to grips with who uses that, how it's used, and how that changes going forward. I guess the more acquisitions that they can feed in, the stronger it gets. But I'll have to see when I look at it. Yeah, I think it's as per last time. Really, I think it's a really, really impressive business with huge size and scale, and it seems to have a good track record of winning the major contracts as well, Steve. So I guess we'll see. I'm not in a huge rush at the moment. I've still got that big old pile of cash. But yeah, this
Which
is an
just got
interesting
bigger because you got a dividend from Bloomsbury today, I think, right?
I did, yes, and it's payday as well, so I've put a deposit in as well. So yeah, it is getting bigger. Yeah.
You've been watching a segment from the Playing FTSE show, brought to you in association with our favourite broker, Trading 212. For the full version of the show, check us out on Spotify, Apple, or wherever you get your podcasts. And if you open a new account with Trading 212 using the link in the description, there's a free fractional share in it for you. Just make sure that you use the code FTSE when you sign up. Terms and conditions apply, and do remember that when investing, your capital is at risk.